Good afternoon, everybody, and welcome to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, and joined, as always, by my good friend and colleague, Todd Anderson. How are you doing, Todd?
I'm good, Peter. Another light week of news.
Not much to talk about this week, is there? So, joined for the second time, we have Stephanie Kirkpatrick. How are you doing, Stephanie?
I can't complain. And like Todd said, there is no shortage of things to cover today as we get together.
Well, why don't you just give us 20 seconds on Aurum before we get into our busy news week?
Absolutely. Aurum is an embedded payments provider focused on all things faster payments. We're a unified API where you can get access to RTP, FedNow, and of course, all the traditional forms of money movement. And we really do the optimization for you so that your teams can be building whatever it is you focus on and not be building out complex payment rails and opportunities. So come see me if you want to chat payments. That's what we're up to.
Okay, sounds good. Well, let's get right into it. And obviously, the story that everybody is talking about, and not just crypto people, but all of finance, and really, it's going into the general population, is all about FTX. So, where to begin here? So, I guess this all started on Sunday when there was a bunch of liquidation requests from the FTX platform. I think $5 billion worth. Didn't have the money, and then there's the FTT token, which we now realize is what was really generating them, or really we're holding the wealth that SBF had, and a lot on the balance sheet of Alameda Research and FTX, and that created. I think it was created Monday or Tuesday. It's been a long week. It created, and basically that meant FTX now, we found out, is facing an $8 billion shortfall. SBF says that they need a $4 billion equity investment. Binance couldn't help them. I mean, no one's going to give them $8 billion. They're toast as far as I can see. Sequoia's given up on them, written the investment down to zero. Apparently, Alameda Research, which the website's gone dark. They're not really, they don't really exist anymore. It seems they owe FTX $10 billion. This is a story that they'll be picking apart for years. It's just one of the craziest. I think the hubris of FBF is just staggering to me.
Yeah, that's some of the most interesting part of this, I think. And when we had the Terra and Luna, and we had Celsius, everyone was throwing their praise towards SBF, how he was the steady hand in the market. He was JP Morgan or Goldman Sachs to the crypto market. He was helping BlockFi, he was helping Voyager, he was helping others. And in reality, he was them. He was exactly what they were, which is, and if you look at his history, he's a gambler.
Yeah.
That's what he is. He's made his money at Alameda by gambling, essentially.
Yeah, trading.
And trading. But, arbitrage and making money, he was very good at it. And he was gambling again. This time he gambled with customer deposits and customer money. And I think the scale of it to, all the way to Tom Brady and Steph Curry, that they put all of this behind him. And he became this figure that kind of rose above everything, when in reality, he was doing very much the same thing as many others in the space, playing it fast and loose.
Mm-hmm.
I think he's got this incredible social proofing behind him, which is how I think one social proof point leads to another, right? So headline cover stories saying next Warren Buffett, hundreds of millions of dollars from Sequoia, like that social proofing.
Yep.
Starts to just eke out, oh, it must work. Somebody must have done homework. Surely Sequoia diligenced the deal, right? Surely if he's on the cover of Fortune, surely if. And I think that's where it is a very slippery slope, particularly in a totally new asset class where we don't have the history and the foundation. And that social proofing makes people want to put money in.
Right.
And without really thinking about the risk they might be taking. What I'm super curious about, Peter and Todd, is what happened on Sunday? What created the run on the bank, so to speak?
Yeah, I think, I know that CZ from Binance said that he was going to be liquidating a whole bunch of FTT tokens that he had accumulated, like not a huge amount, like only like 300 or 400 million, but it was enough to sort of soak up the liquidity. And suddenly FTT token went down. And I think this is what really is amazing to me is that, see, these crypto tokens have nothing backing them. I mean, USDs, the stable coins have actual backing, but all these other ones, even Bitcoin, it's just supply and demand. There's nothing there other than supply and demand. And if there is no demand and everyone wants to sell, it just goes down like this is, they said, I was reading, I think it was the Wall Street Journal, the information was it's the fastest collapse of a personal fortune in world history. Basically 1 week he's gone from $26 billion net worth now to, they say, in the hundreds of millions, but it's still staggering in a week that you can do that. And boy,
the speed at which it happened is pretty astonishing. And just and how quickly then CZ and Binance stepped in and then stepped right back out.
Right.
All at the, I mean, this
there was something.
There was something.
That tweet.
Yep.
Which tweet?
That felt weird, right? The one that said, "Hey, we're non-binding letter of intent." Something about that tweet made me stop and go, "Non-binding letter of intent. That doesn't sound like a sure thing." That's how I read it.
Right.
Yep.
Right. Yep. Well, and as in, and I think
it was only like 2 hours later. I think the initial CoinDesk article came out that they're seriously considered backing out already.
Yeah, it was.
And this was a span of 3 hours.
Well, I think they sent the balance sheet over, and they said, "Can we get the detailed dump of the balance sheet?" And they go, "Oh, this is really
never mind.
No one's going to touch this." I mean, you've got to be. There's only a handful of people / companies in the world that would be able to really bail him out. I mean, he's right now. It's just a case of how it all is going to go. And I was listening to the Bankless guys on the way in, and they were saying that he it's most likely jail time for him, because it looks like he has done, and this is obviously, we don't have this firsthand or even secondhand. It looks like he has taken customer assets, and these are people that are buying tokens on buying coins on FTX, and then taking that money and lending it out to Alameda Research, and that is. There's some very legal question marks about whether, does it sound like a lot of these things are going to go well for SBF?
I thought one of the funny things I saw was, as it was unfolding, I think it was Jason Calcanis had a live stream going on with a couple of crypto people, and basically there's a reason why he operated initially in Hong Kong and the Bahamas. And there's a reason why he didn't ever set up full shop in the US, and Alameda and FTX, shouldn't have ever relied on one another. And it goes down to basic risk management. Right. That, he failed that. And once it got intertwined initially, it was just, it took off from there. But even the Bankless guys are like, so what if Alameda fails? What does that have to do with the FTX? And I think they were being facetious, saying, what does it really have to do? When in reality, it has everything to do with it.
Right. Well, considering,
I think this is where that concept of margin and risk taking and a history as a trader also, I think, comes into play, which is actually, in reality, unbeknownst to most of us, our money is being margined half the time and leveraged by banks and financial institutions. Whatever's on deposit, it does get lent out. It does get used.
Sure.
There is a concept of this arbitrage. And so I think the concept, exists in the financial system. The sort of trigger point here is being over leveraged at a time in which there's an external force strong enough to put fear in the market to say withdraw, right? Had that not happened on Sunday, and that's what is so curious, is there a conspiracy theory here or not about CZ? I don't know. But that sort of run on the bank situation might never have happened, right? This all might have played out totally differently if we hadn't had that trigger factor. And I think that's where these sort of interesting plays always get pretty tricky.
Yep. That's a very good point, Stephanie. I feel like that, the other thing, like you put your money in a bank and they leverage that money by, but they have something backing, and they have capital, they have ratios they've got to adhere to, and
ultimately the FDIC insurance is
they've examiners coming,
making you feel better.
Yeah. So
well, it speaks to regulation, which I think is what we're going
right.
to talk about next.
Yeah.
Yes. So let's get into that, because really, no surprise that we've seen the Department of Justice is looking into FTX. The SEC has an ongoing investigation into FTX because they've done an ongoing investigation into lots of crypto companies about whether or not they are trading securities, and that's obviously, this goes far beyond that. But the SEC has requested information about the ties between FTX, FTX US, and Alameda. This, I think, in some ways, if we'd had regulatory clarity, this could have all been avoided if we'd gotten sort of this all nailed down a year ago, but it didn't. And now, what is almost certain to happen? You've seen lots of tweets from regulators and from politicians saying, "Well, this is unacceptable. We've got to," and the politicians are probably going to come in and legislate now. But the regulatory piece, this again, I feel like is a shortcoming. But they're going to do investigations, and I think they're going to find a lot about it.
I feel like some aspects of it, I still feel like would have happened, in the sense that, he wouldn't have been able to scale nearly at the pace he did if he had set up shop here versus where he did. Right. Even if regulation was clear here, does he still set up shop there because he knows how quickly he can scale? Look at Binance. I mean, that's essentially how they've done it, except they release their wallet addresses that show they have almost 70 billion in reserves. But I don't know. I still think some of this maybe plays out. Now, does it play out to the scale? Probably not, because maybe he does more of a split business, and FTX US kind of gets traction, even though it's very small right now. I think the ultimate regulation point is, if I'm in the crypto industry right now, especially in the US, the regulated version of it, I would be like throwing myself at regulators that we're not SBF. We want to play within the rules. We want to help you write the rules. I mean, this is a really good moment for them to try to take the lead and help craft the legislation. Because if they just kind of leave it to the regulators, I think they're gonna whack them. And it's
I think
unfair.
That's key.
Yeah.
Well, I think that's key, Todd, because, if you think about it, if we had a better kind of mark to market, so to speak, of regulators and innovators, I think what we'd hope to see is that we don't end up having legislative backlash and catastrophic events. What we have is comment periods and accelerated, coordinated efforts to have the comment period reflect what's right for the industry, right for the consumer, and build the regulations effectively, pacing relatively closely to where the innovation is going. I think we saw this in the week of Money 2020. There was CFPB news about kind of quickly moving a piece of, regulation forward. And there's worry that will happen too quickly and it won't kind of suit, the comment period that's required. And so now we find ourselves in this kind of severe situation. How many years has it been, years, plural, right, that people have been investing in cryptocurrencies, that people have been putting money into effectively a speculative investment? And it's been unclear if it is or isn't an investment. So where were we with thinking about that regulatory question 3, 4, 5 years ago, when the mainstream aspect really started to pick up? It shouldn't take, in my opinion, a catastrophic outcome to create the regulation, but it's such a divided industry, right?
And we've had 5 years since that first crypto bull run that really, the 2017 ended in like January of 2018. So we've had 5 years, and virtually nothing has been done in this country anyway. I mean, virtually nothing, and that's a real shame. And caught in the crossfire, of course, is Coinbase. They are a centralized exchange, just like FTX. It's different type of customer, but we had Brian Armstrong, CEO of Coinbase, tweeting out. And this is one of the things I love about the era we live in, is that this unfolds in real time. We get to know. It's not like we're talking about the financial crisis with Lehman or Enron and those blow-ups. We found out by investigative journalism and a little bit leaking out here and there. But here we have the people, the central figures in this amazing story, tweeting out in real time what's actually happening and what they're thinking about. And so Brian Armstrong had a tweet thread saying that we have no material exposure to FTX or Alameda. They have no relationship with Alameda whatsoever. And he basically little subtle dig at regulators, saying this is a result of no clarity on crypto regulation. And the fact that so much activity is happening offshore. But for Coinbase, this is a black eye for the whole crypto industry. I think it. There's people are hoping for a bull run in 2023. I think you can kiss that one goodbye. It just feels like there's such a black eye for the industry.
And I know that he's had his own somewhat run-in or history with certain regulators and some Twitter spats in the past, but I mean, even that, it seems like he's like taking a dig because he wants to take a dig, and when the opposite could be, hey, Gary Gensler or whoever, let's really put some clarity on this. Let us help you. Let us write it. And I know that there's a divide, as you pointed out earlier, Stephanie, but I think it's going to really hurt the industry if they don't get behind one another and figure out a way to kind of move together. Because if this split continues, like Peter said, 23, maybe 24, maybe 25, it starts to kind of really come back. But there's going to be people that sit on the sidelines for quite some time.
Yeah,
I think that's right.
Yeah. Well, let's move on, because we have talked about, we're not talking about crypto for the rest of the show. We're done with crypto. But
let's see about that.
This I feel like would have been our main story on any other regular week. Elon Musk details his vision for a Twitter payment system, and I mean, he had a live stream on Tuesday, and apparently people worked out he's applied to FinCEN to be a payments processor. He's talking about maybe doing small dollar payments. He's talking about peer-to-peer payments. He's even talking about offering full like digital banking services at Twitter. So, but I mean, the payments piece is something maybe, Stephanie, you're obviously deeply into the payment space.
You forgot the Dogecoin though. I'm just kidding.
He hasn't mentioned Doge. But anyway, what did you, I'm sure you've looked into this in depth. What's your take on the Twitter move into payments?
Well, as a company who has spent time with FinCEN and the registration process, I can say that in all regards, actually, it doesn't surprise me. And I think, today you associate Elon with Tesla or now Twitter, but remember, he's PayPal, he's OG PayPal Mafia.
Yeah, exactly.
And so it doesn't surprise me at all, actually. In fact, I think it's quite strategic. Will it play out to look like a WeChat? I think it's a little bit unclear sort of what the super app component ends up being. But it's absolutely within reason that you could take a critical mass like this, where there's a community aspect, and turn on peer-to-peer payments at a minimum, and have a really influential marketplace. I mean, I think if I look at the way social media in general has created buying norms, let's take Instagram, right? In-app, in-experience, I'm effectively looking at something I like and clicking to buy it, and I'm never leaving. That kind of embedded transaction in a tweet is very possible. Mm-hmm. I'm not surprised. I think the amount of work that goes into registration and frankly, the statewide process means, best case, even with the fastest moving innovation, there's probably not really something material in market for another 6 to 9 months. And even then it's going to be limited by hard to reach states like New York, who are loath to make approvals, casually in the MSB MTL space. So I think time will tell how exactly the strategy is going to play out. What I like about it is, one, I think it puts us back in a place where like payments being embedded in other services is top of mind. Mm-hmm. And two, I think just generally for Twitter, the idea that it's possibly going to serve a different purpose, the boundary of innovation is being pushed, is pretty interesting. I think it's worth noting that all is a side effect of having laid off thousands of people and taken a pretty dramatic, turn of events for folks whose jobs were at stake. But the payments piece is certainly interesting.
Mm-hmm. Mm-hmm.
I think it also puts added pressure on FedNow and even others in the payment space, like faster, cheaper, better payments is only beneficial to the overall ecosystem of fintech and to the consumer and small business. And if he helps get there, and I mean, there's a lot of companies like Orem and others who are helping us to get there today, but he has this ability to kind of galvanize either people or in good ways and bad ways at times, but he is a lightning rod, and maybe he helps to push this forward, and FedNow gets a little bit quicker. I don't know, but it's interesting to see that he's going back to his roots.
Right. Well, the FedNow piece, Orm did a webinar with Chief Product Officer Dan at the Fed yesterday. So fresh top of mind thinking, which is they effectively have a 5-year roadmap to get to thousands of financial institutions. So catalysts like this could potentially be huge in terms of getting more progress on faster rails, which have so much value for the American wallet.
Right,
Yep.
right. Well, let's talk about Fed now, because there was news out late last week. We just missed it in time for our show there, but I wanted to put it on because I knew this was all about pricing, and basically Fed now saying it's going to be free or very, very limited pricing when they launch. And given that you just said you did a webinar yesterday, Stephanie, why don't you tell us about the rollout of how you're expecting Fed now to happen in 2023?
Yeah, so full disclosure, Orem is partners with the Fed on this. I'm a big supporter, also supporter of what the clearinghouse has built on RTP.
Mm-hmm.
And I think one of the reasons that you're seeing the Fed take proactive action in publishing the fee schedule and the discounts and making it something that from a price point perspective looks reasonable is to further adoption, right? We talked about this yesterday. The idea that it's not going to be high cost, high friction is really important. And to be able to send a faster payment, let's take the kind of like next in line fastest option. It's 5 days a week. That's going to be probably a wire for a lot of higher risk type of transactions. That's an expensive transaction. So at 4.5 cents, we're beating card rails, we're beating wires, we're beating lots of alternatives. And that is what part of the rollout plan includes, which is the path to mass adoption, right? So I think the Fed's done a really good job of thinking about what are the major barriers to entry such that we could make this really feasible, especially for small banks. Let's be clear, right? The folks that own the clearinghouse that built RTP and the top 20 banks that use these faster payment rails probably have the technology teams to build all of this out and afford it. Smaller banks don't. To make it price friendly is going to be incredibly important.
And in the aggregate, I mean, I don't know what the exact numbers are, but there's, if not 100 million customers that use small banks, I'm sure, or something close to it in the aggregate instead of, the concentrated in the top 20. Question I had for you is, you mentioned FedNow, the clearinghouse. We've talked about on this show many times, Apple and Block and others that seem to be creating their own kind of mini payments ecosystems. Are we risking something in the future that there's lots of these different mini ecosystems that don't necessarily connect to one another?
Well, it's a really
you need
interesting
Orem, right?
That's certainly part of why you need Orem, right? The interoperability, actually, Peter, to your point, becomes really complicated, right? So if you think about it, I can talk to my mom, right? And I can be like, Mom, I need to pay you back. She's like, you can PayPal me or you can Venmo me, which PayPal owns Venmo. So they're almost effectively the same solution. Now I could Zelle her. There's just so many ways to do a payment. And Zelle is a closed loop promise to pay network. It's actually not a settlement system. So I think we have to distinguish in the payments world, what is actually settlement versus what is messaging and promise to pay. I'd like to believe that we have fewer closed loop peer-to-peer networks that are exclusionary, and we have more frameworks that allow seamless, portable information to be used to generate a transaction. And I think this is where, I love the way the Fed thinks about their policy initiative, which is in order to fund Fed Now, which was the most controversial decision, according to Dan, their product leader, they had to have a policy initiative, which is every American should be able to pay another American instantly. That's powerful when you think about the objective of what they're trying to achieve. So I think what plays out is that we, find that what powers a Cash App or what powers an Apple Wallet may end up being some of these better, faster payment rails so that settlement is actually complete. And it's not just an arbitrage. If I Venmo Peter $100, Peter, you can now buy crypto with it, spend it on a virtual debit card or a physical debit card, Venmo it over to Todd. The Venmo hasn't received Stephanie's $100 yet. So they're just effectively advancing it. So what if the settlement layer underneath Venmo, underneath Cash App was Fed Now, right? So that is where I think we may not see changes in the behaviors of where we started to use app-based products, but we may definitively see changes in the infrastructure. And as a result of that, potentially favor different solutions that are more cost effective and more favorable to the
a lot less fraud that way too.
Yeah.
So just one question before we move on. Like when Todd's talked about this before, going out to small banks, you said they want to have every American to every American. That small banks, some of these tiny banks have 2 people in their IT department. How long is it going to take for them to get on board?
Well, according to the Fed, this is a multi-year initiative. They say that they'll be to the thousands of banks. We have about 5,000 banks in the US. They'll be to the thousands by the 5-year point. That's their forecast. I think what gets interesting here is alongside CFPB regulation coming out about open banking, or open finance rather, how does the portability look 3, 4, 5 years from now, and the willingness to switch? Why don't people switch banks? Well, they don't switch banks because direct deposit's hard to change. They don't switch banks because their bill pay setup and it's hard to change. So if in parallel, the adoption plan gets to a majority of banks and the opportunity and ease by which consumers or business owners can switch banks increases, I think we get near ubiquity.
Okay, so moving on, want to talk about Goldman Sachs. They were in the news again this week. I thought this was really interesting. This is in the Wall Street Journal. They were looking at buying one of the credit card technology firms like Deserve or Cardless and CoreCard, and they ended up not doing it, and they built it themselves. It reminds me actually of the start of Marcus when this is a story I don't even know if this has really gotten out very much in the public eye, but they looked into buying Upstart and didn't, and then went and built it themselves. So who knows how much of it was just looking for the due diligence for the technology. But interesting, I had no idea that Goldman were out there, and these conversations are no longer ongoing, but they were ongoing for quite some time, it seems.
It feels like Goldman's really known for having a bias to build, right? I do think that there's some examples, Final Card, which they acquired, which then turned into the first version of Apple Card. Certainly acquisition wouldn't be off the table, but they do seem to have a bias to build themselves, and they certainly have had a bias to find a way over the hurdle into the everyday American household. And I think they haven't found it yet, right? They certainly, with Marcus, all data suggests that they haven't gained the traction and figured it out in a meaningful way.
Mm-hmm.
Yeah, they've kind of gone back to just doubling down on the stuff they know well, and this kind of feels like they were just getting a sense for what some of these technologies can offer, and how close could they get to it by building it themselves.
Right. Okay, we're going to finish this week with Upgrade, Renaud Laplanche's company, and this actually did come out last week, which we missed it on the news show, but we're catching up this week with the Banking Dive, talking about their new savings product, 3.5%. When they launched it, it was the highest in the nation. No longer is, apparently. There's one at 3.75, but it is going to, as rates increase, savings rates are going to increase. But this is really interesting because Upgrade have a lending product that's working. They work with a bunch of community banks and credit unions. They basically these community banks and credit unions, fund loans to Upgrade customers, and now they're working with these same banks and credit unions, finding them deposits. They're like a marketing arm for these smaller banks who really don't have the deposit kind of heft of some of the bigger banks who don't necessarily need to be paying large high interest rates on deposits because they're awash in deposits, but it's not the case with the small banks. What this article is saying anyway. So Renaud Laplanche back getting onto the other side of the balance sheet.
Yeah, I mean, this is, it seems they've quietly gotten themselves some pretty good traction while there's been a lot of noise going on in fintech, lots of layoffs, all this stuff. It seems like they're quietly performing, which is kind of opposite to the way Renaud used to operate back in the Lending Club days with their vests and everything. But I mean, this is where fintech, I think, can be hugely beneficial when it comes to not only community banks, but financial inclusion, because getting through to the end customer and helping these banks, it keeps some of these banks online and the customers interested through these banks. And it's probably revenue that otherwise is hard to get when the customers are already through the bank. So I'm sure it's an easier path to both ways. But Upgrade seems to be performing pretty well.
Well, if you think about the funnel for a second, right, of digital opportunity, it's wide. We can go out and reach a wide audience of people with a varied set of backgrounds and risk profiles. An individual bank, especially with 1 to 2 physical locations, without that technology, really can't create much of a funnel. What I think is interesting from what I understand about what they're doing is being able to open the aperture digitally and then effectively create a matching model that says customers of this profile make sense with this bank. And by bringing deposits in a time in which deposits are interesting for everybody, certainly it's been a long time since my bank account was paying 3.5%. It's a really interesting model to think about, kind of the opposite of what I see other fintechs doing. Fintechs are kind of huddling, let's say in the neobanking space, a lot of concentration on the back of a single, or maybe as they scale 2 program banks, which, as we've talked about on the show previously, doesn't always bode well for how regulators think about the pressure that puts on a bank versus a distribution model, which is better matching. Hey, there might also be lending products and other things that suit this profile customer. Let's bring deposit business to you, but they've created a streamlined way to do that. That to me is super interesting. Totally different take, in my opinion, on the sort of neobanking profile.
Yeah, that is very true. So we'll have to leave it there, though. Stephanie, thank you so much for coming on. Todd, great as always. But before we go, I almost forgot. If you are interested in a Latin American fintech, you have to be in Miami next month, December 13th and 14th. Fintech Nexus Latam. We've got all the big names coming to Miami. So check out fintechnexus.com for more information on that. Okay, have a great weekend, everybody. Thanks again, Stephanie and Todd. We'll
Thanks, Peter. Thanks, Stephanie.
Okay.
Thanks, guys. We'll see you soon.
Yep.
Bye.
Bye.